Welcome everybody to a quarterly review for the first quarter of 2021. We've got with us Randy Farina, one of the equity PMs. Randy, welcome.
Thanks, Pete. Glad to be here. Glad to discuss the markets and the quarter.
Excellent. So we have had a extraordinary 12 months, to say the least. It's last quarter or last year, this quarter, we were dealing with the throes of the pandemic. There was a lot of uncertainty. And now we're sitting here a year later, feeling a bit more confident, a little bit more secure of what we know in dealing with the virus. Randy, over these past 12 months, what have been our key or our biggest takeaways from that extraordinary period?
It certainly has been an extraordinary period, Pete, over the last 12 months. I've been investing since 1999. I've gone through a few events that at the moment, were unprecedented, 9/11 being one of them, the great financial crisis being another one. But I'd have to say this one, tops the cake. That was a significant event in that I've never seen global economy basically grind to a halt within a few weeks. In hindsight, as we sit here 12 months later, the lesson learned, and this was a lesson learned, during other crises and panics, is not to panic, not to focus on the short term. Don't shorten your investment horizon. Don't make knee-jerk reactions. And always try to remember, if you have a 10 or 20-year goal for whatever you're trying to save for, you need to keep that time frame in mind. Your investment decisions should be conscious of the time frame. If you need cash in a shorter period of time, then you probably shouldn't be in the equity market. But if your goal is 20 years, I think what a lot of people do during the panic, during the fear and the sell-off, is they capitulate. They sell into it, Pete. And then they wait. And they wait for the information to come out that, hey, there's therapeutics now. We know how to treat it a little bit better. We can start to wear masks in public. And then the vaccine comes out. So a lot of the concerns that originally were prevalent in March, the unknown starts to work itself out, and then the markets start to gain more confidence, gain more vision for the future, and start to then react positively. So lesson learned is to always try to focus on the longer term and not get caught up in a panic or a knee-jerk reaction to any news.
Gotcha. How would you describe our portfolio positioning from the throes of the pandemic to actually today? We had obviously the fear and the panic in the early months of 2020, replaced by the hopefulness and the reopening narrative that overtook the markets from the time that the vaccine was actually announced. How would you say that the portfolios reacted to this, and how have we reacted as investors?
We've been opportunistic. The way Pete and I run the portfolios that we're responsible for at Exencial is that we really have a long horizon. We try to have low turnover, and we try to focus on 3, 5, and even a decade. So a lot of our decisions are not based on 1 quarter or 1 year's horizon. It's really trying to calibrate the risk reward or the opportunity on a stock over the long run, a business. We're trying to price a business as if there is no stock market. And typically companies are not trying to focus on the next quarter or the next year. A lot of the decisions they make are focused on the future, and we try to do the same in the portfolio. We were defensively positioned going into the pandemic. There was a little bit of valuation concern in the market. We were having trouble finding good opportunities at that point. But when the pandemic hit and markets sold off significantly, we did use some of the cash and some of the other equities we held to reposition and buy some growth stocks, you would say. As we got into the fall, a lot of the stocks that did very poorly or had not recovered to pre-pandemic levels were things that were very economically sensitive. Anything related to materials, anything related to energy, airlines, hotels, travel. a lot of those businesses clearly had a significant disruption to revenues and profits and will for the next couple of years. When the vaccine news broke in November, that started to at least pull forward the time frame of when we could get back to normal. So Pete and I, in both the core and international portfolio, did buy some airlines, some energy, some basic material companies, because we thought that the opportunity in those stocks presented itself, that the market was still a little bit short-sighted on the value of those businesses, and we thought we could capitalize. So I'd say over the last year, we have not done a lot of turnover in trading, and when we have, it's to try to capitalize on what we think is an opportunity that we see at the moment.
Excellent. So would you say that given that the extraordinary fiscal, I'm going to use extraordinary a lot, but given the extraordinary fiscal and monetary response to the pandemic, I have heard, and there's a legitimate fear of actually a policy error. And to that extent, how do you feel about the possibility of inflationary pressures and the possibility of a policy error when it comes to dealing with that?
Sure. So policy error will, in hindsight, we'll know whether there was a policy error or not. I do think the global response to COVID was swift, and I think it was the correct move to flood the economies, flood the markets with liquidity, and from both a fiscal and monetary standpoint. I think the lessons learned during the great financial crisis was that they didn't move fast enough. There was different set of circumstances for sure, this crisis and that crisis, but I think the delayed response in the GFC was, in hindsight, an error. Also, some of the austerity measures that Europe took during the GFC impacted the recovery and the length of the recovery. So this time around, the markets globally reacted very swift, very fast, and with a lot of capital. So that now leads to a year later with, hopefully, the vaccine distribution continuing to roll out and back to normal, closer than far away. Now the concern is, was there too much capital put into the system, injected into the system, and has there been too much fiscal response from whether it's the US, Europe, or Asia? Time will tell. It could lead to inflationary pressures, but I do think some inflation is good. I think what happened post the great financial crisis is that Europe had deflation, and it's hard to grow when there's deflation. So some inflation is good. Too much is clearly not a benefit to the market, but we won't know. How Pete and I are reacting in the portfolio is to monitor the situation. There's no knee-jerk trades or reactions happening in the portfolio. We're trying to calibrate economic data, macro data with individual company-specific data to make what we think are the right decisions for the portfolio. So Pete, to answer the question, we'll monitor it, but we really won't know if there's a policy mistake or and inflation is going to be an issue. I think we need more time before we can calibrate it.
I agree with that. I think it's something to monitor. There's really two schools of thought, and they are competing against each other. There's the inflationary part of the market that thinks we're just going to have rampant Germany-like inflation pre-World War II, and we have the deflationary camp that says, well, the moment that the base rate effects go away, we're going to have deflation again, which kind of speaks to how the markets are a discount mechanism that take both views, and somewhere in the middle is where we're going to find this the correct answer is. Another question that I want to ask you is. I was reading in an article that about a third of the small cap companies trading in the United States were unable to turn profit for 2020. Given the recent run on the small caps, it seems that the market is somewhat ignoring the fact that they were not profitable. They're seeing something in the future. and they discount it back. You and I are fundamental investors. Just would like to ask you how difficult it is to value companies in the current environment.
Sure. I think a couple of issues are raised in that question. Small cap companies in general, let's take two extremes. A growth company that's, a disruptor and new to the market and addressing a new market. They're worried about their first mover advantage, growing their market share. So revenues is their main focus. And they may not have any earnings, and they may not have any earnings for 2, 3, even 5 years. So I think, our methodology, whether it's a growth or value company, is to try to look out into the future, put some reasonable proxy for long-term cash flow margins, capital intensity, and come up with what we think is a reasonable, fair value of the business. You could take on the other side a value stock that is related to energy or materials or restaurant or something that in 2020 had a significant event where they were under earning, to what their normal level of profits are. And so they could have had negative earnings. That is a different focus because then we're trying to figure out when the normal is, how quickly do they get back to that, and then we can value the cash flows based on a return to normal and discount it back. I guess it leads into whether a company is small, large, U.S., international, growth value. I think Pete and our philosophy in general is that we look at an intrinsic value of the business. We're trying to value the business as if there is no stock market. We're trying to look at cash flows not only 1 and 2 years out, but 5 and 10 years out. We're trying to think about the competitive moat that a company has or is trying to develop and what that means to longer term margins and capital intensity and balance sheet. And, using our experience, I've been doing it for 20 years, Pete over a decade, and our knowledge of global markets, again, whether it's U.S., international, small, large, I think our philosophy helps us identify opportunities that exist because the market typically has a shorter term focus. The average portfolio turnover is close to 100%. That means, they're turning over their stocks one time a year. We target a 5-year holding period, which is more 20% turnover. So again, we're trying to use the market's sometimes short horizon to our advantage in that we look long term and we think about values, intrinsic values over the longer run.
Excellent. Thank you, Randy. Well, this was the quarterly review. It has been a pleasure having you over. Hopefully we'll do it again.